First to our top story. Markets are looking okay today, but they are heading for a trifecta of losses for the week. All three indices set to end the week in the red, with Apple dragging the Nasdaq and the S&P with the iPhone maker taking close to a $200 billion hit. This is a result of China's new iPhone restrictions. Let's get right to Optimal Capital Director of Strategy, Francis Stacy, and Exiger CEO Brandon Daniels. Great to see you both. Thanks for being happy Friday to everybody out there. Now, even for Apple, because we know how much cash they have on hand, Francis, $200 billion is still a big deal. It was a bad week for Apple, bad week for the markets. What's going to happen next week? Your best guess.
Yeah, so it was a bad week for Apple. This was definitely bad news, even though so far it is contained. We don't know if the ban is going to be extended. But most importantly is if you look at the chart, Apple held its August 18th low of 171.96. So it didn't trade below that low. So bidders came back in yesterday. It closed well off of the low. And that's a good technical signal for Apple. That news has now been priced in. It's been print. But as far as tech stocks go, the challenge is that they have very lofty valuations that came from a lot of the AI hype. Apple plus NVIDIA equals 11% of the S&P 500. So movements in those two stocks are going to create a lot of movement in the indices. The NASDAQ 100, I'm not concerned that tech is over until it starts failing and closing below 15,000. And then the reversion to the mean when we actually take, the most recent bubble out of tech is going to be about 12,500. But I don't know that we're going to start that just yet.
Brandon, I think a lot of what's making investors nervous right now is their faith in the Fed. I mean, it was shaky about a year ago when clearly they were way wrong on inflation. Then it began to strengthen and people said, okay, well, maybe we're going to go into a soft landing. That kind of came to an abrupt halt late last week and earlier this week with concerns about inflation, particularly when you look at the price of diesel fuel, up 42 cents in August alone, and just about everything moves on diesel. That has got to translate into higher inflation.
It absolutely does. It's a big part of the overall market conditions that are going to create enhanced demand on critical goods, right? We're seeing a reduction in spending. We're seeing some of that demand pull from an economic perspective start to wane, but that still doesn't ameliorate the issues that we have in terms of supply shocks as we look at the Russia-Ukraine war, as we look at continued challenges in price models and some of the core commodities. It's hard to shake those things off. And I think the Fed is going to have to continue to lean in. And I think that they signaled that the last time that they met and presented.
And Francis, of course, leaning in means another rate hike. How will that affect our nation's economy? And in particular, I mean, housing prices were up a little bit, which was a surprise, a good surprise that we got. But the housing market in general is kind of frozen right now. If rates go up over 8%, which could happen with another Fed hike, what happens to our economy then?
No, the real problem that we have in our economy is about 60% of the populace is living paycheck to paycheck, and they're increasingly putting things on credit card debt, which is becoming more onerous with every rate hike.
Great point.
However, to talk about oil is up 30% off of the low. There's about a 1 to 2 month lag before oil shows up in headline CPI. So we know that all of the commodities prices that have risen due to the demand in July, we had Barbie mania, we had Taylor Swift mania, we had a drawdown in savings, we had a number of sort of interesting drivers for July and the demand in July that are going to show up in an increase in prices in the coming months because there's a lag effect, say 4 to 8 months for food. So the Fed is going to have to remain completely tight, totally hawkish until they break something. And I know that they're going to pause in September with the kind of wait and see because some of these, catalysts are going away as student debt payments come back online. Yes. But the problem is that in November, if we don't have any kind of a credit situation, the Fed is going to be stuck between a rock and a hard place and continuing to tighten. And fiscal policy, we've got the debt ceiling coming up again. So that's counteracting.
We're gonna talk about that, but I want to get Brandon in for a final point, because yesterday then we have the issue of the president essentially breaking the law. I mean, there's no other word for it. He rescinded a part of the 2017 tax code that had to do with drilling in Alaska. Sort of on his own, he did it. There are questions about whether that was legal or not, but that clearly sent another message to futures markets on oil that it ain't going to get any better.
I think that the political issues right now are going to dominate the markets. And I think that's what you saw in the beginning of the top of our conversation with Apple, where you see geopolitical tensions between China and the United States starting to pull back on the markets. I think political issues when it comes to different stances on ESG. I think the various incentives that we have between European relationships with China, or some of the Eastern countries versus the United States demand for independence. Those things are going to create these political clashes over the next year that are going to leave the market in a tenuous position until we can start to see interest rates start to stabilize, and we can see consistent growth, and we have evidence that the soft landing has happened.
Fasten your seatbelts, everybody. Francis and Brandon, great to see you both. Thank you very much for being here. Appreciate it.